would like, if I may, to take you on a strange journey.
Hello, everyone, and welcome to another edition of Real Estate Realities with the Rebel Broker. My name is Robert Whitelaw, and I am the Rebel Broker, licensed real estate broker in the state of California. Member of the National Association of Realtors. But please, don't hold that against me. Welcome back, everyone. We've got a couple of interesting bits of data today. A great one that'll dovetail perfectly with what we talked about yesterday. We've got some of those numbers in terms of home construction, right? We were talking about builder confidence was up yesterday, and we need to see that translate into action, right? Right? Doesn't matter how good you feel about something if that does not translate into an action relating to that feeling. Then we've seen over the last year and a half huge disconnects, right? We've seen very big numbers in terms of confidence numbers, but not anything that seemed to point to actual actions that would do anything. We'll see if we're continuing to see a disconnect. And we've also got some interesting news from the Wall Street Journal relating to what builders are saying they're going to focus on. Again, I want to see actions. I want to hear less talk about what they're thinking about doing and actually see more of what they're doing. Plus, we've got another story about what current grads are thinking. Everyone continues to sort of want to celebrate the millennial rush to move out and buy homes. Doesn't horribly look like that's happening. There's theories running around that it's gonna. We'll see. They seem to go back and forth. A year ago around this time, we were talking about how millennials were going nowhere. They were staying with mom and dad. All these other kinds of things that were holding them back really from moving into the marketplace. Then we went through this rush at the beginning of this year where they were talking about how millennials were looking like they were really going to come out in 2017. Now, remember, they said the same thing in 2016. But let's put all that aside for a second. At this point in the marketplace, do we really want any large group rushing into the marketplace? In most areas, no, right? We've already got a demand level that is causing a already low supply to become more and more expensive every single day. So in terms of affordability, the worst thing that could happen would be for millennials to decide to jump onto the bandwagon and start looking for a home, because that would artificially boost prices, right? Well, let's go ahead and explore all of the various tidbits of news today. But before we do, let me remind everyone how to get in contact with me. The best way is to head over to the website at therebelbroker.com. From there, you can click on Contact in the menu bar. You can send along any ideas, suggestions, observations, or questions that you might have. I'd be happy to field them for you. Maybe even mention them on the show. Who knows? We might turn it into a topic to discuss. And of course, while you're there, I always encourage you to click on the big red button at the top. Why? Because it's a win-win. That's why. I win because you support the show. You provide a little demographic information that helps me move forward with growing the show. And in response, as a way to thank everyone who goes to the trouble of doing that, I've been doing a monthly drawing for a $50 Amazon gift card. Just did the drawing for this May have to do another one, though, because this is the first time we've had someone not respond on their email address. I'm hesitant to... If you are someone who has sent your email in using the big red button at the website that says take the survey to support the show, and you haven't checked your email since before Friday last week, please go and check it. Because if you have won the $50, I would hate to abandon you and move on to someone else. But I'm thinking I'm gonna cut it off tomorrow, Wednesday. And at 5 p.m. tomorrow, I will do another drawing. I will draw another person. So assuming that person doesn't reply, for those of you who missed getting in on the deadline for this month, which was last Friday by 5 p.m., you now may have a window between now and tomorrow at 5 p.m. or today at 5 p.m., Wednesday at 5 p.m. So take advantage of that And if you don't make it, if someone doesn't, the person I messaged doesn't claim the $50 gift card, you would be in the drawing for that. If they do claim it, it just means you're in the drawing for next month. So either way you win, right? Okay. And of course, you can also join the Rebel Underground. You can text the word Rebel Broker, the number 44222. That's text the word Rebel Broker to the number 44222. Or you can simply go to therebelbroker.com, go to the show notes for any show, and click on the button that says Join the Rebel Underground. All right. I think that's everything. No big updates on the state of my home improvement. It's looking more and more like I may not make my personal goal deadline of being on the market before the end of this month. I've got a budget and I really want to stick to the budget, and I'm finding that once I find a solution, I'll share with you. But right now I'm looking for more work that I can do myself. So I've kind of given up on the idea of hiring a painter to come in and paint the inside. I'm going to do that and maybe enlist my kids to do some of it. The tile work in the kitchen I'm going to do myself. A few things I feel qualified to do. I'm going to replace a door. I've replaced doors before, so I don't feel like that is a huge deal. So there's all that. Anyway, we can get into that when I have more fully realized advice that I can give you, because we're still kind of in the process of doing that. All right, so let's go ahead and jump on our first story. This is a good one to start with. So new home construction. And remember, we talked about the perception of optimism with the National Association of Home Builders. We're at super high numbers. We're at 70, I believe, and anything above 50 is positive. We talked about how that number puts us on par with when we were at our peak just before the downturn, which and just to calibrate, what was going on. If you take the charts that I've never seen both of these things on the same chart, but if you take a look at a chart of in progress construction, and if you were to overlay that on optimism from the National Association of Home Builders, you would find that right now we're at the same place more or less in terms of optimism about home builders, but we are nowhere near at the level of building that we were then. So there clearly is not a one-to-one relationship all the time between how builders feel about the market and what builders actually do in the marketplace. Since the last time we were at this kind of number in terms of confidence, in terms of sort of feeling enthusiastic about what the future of building homes, we're way off from where we used to be. So we can either take that as things are about to ramp up. We can take that as an indicator that, well, hey, if opinion is going to start to be in line with the actions that are being taken, that sure would indicate we're going to see a boost in building. Now, that hasn't been historically true over the last couple of years. All the times that we've explored the confidence numbers versus the action numbers, which are things like permits, buying lumber, those types of things. Now, as I mentioned before, there was some reports a few weeks ago that lumber prices had gone up, which would mean more demand, right? More lumber sales had gone up. But unfortunately, what we're seeing with the numbers today, new home construction takes a blow in April. This is an article that comes to us from Housing Wire. New home construction took a blow in April as, although single-family starts saw a slight increase during the month, building permits dropped, according to the latest report from the U.S. Census Bureau and the U.S. Department of Housing and Urban Development. Let's see. Housing starts in the private sector decreased in April to a seasonally adjusted annual rate of 1.17 million starts. That's down 2.6% from March. Just as a heads up, we would actually expect to see that number increase over that time period. Let's see. So that's down 2.6 from March, but up 0.7% from last year's number at the same time. So in terms of the seasonal month to month, a little bit odd, but in terms of the comparison with where we were last year, a little bit better. Single-family housing starts increased slightly in April, rising 0.4% from March's 832,000 to 835,000. Housing units, private-owned housing units authorized by building permits also decreased in April, falling 2.5% from March's 1.26 million to 123 million, but also still 5.7% above last year's 1.16 million. So in terms of how the market feels to you, if you're someone who's kind of trying to estimate where you sit in this marketplace, it should feel better than it did 1 year ago. The article goes on to say that despite the increase in single-family starts, single-family authorizations slipped, falling 4.5% in March. This indicated new home starts may soon follow the downward trend. Privately owned housing completions fell in April to 1.11 million completions, down 8.6 from March. Represents an increase of 15.1% from last year's number, though. So that's actually a pretty good number. Single-family housing completions dropped 4.5%, down from March's 821,000. Let's see. There wasn't anything else particularly awesome in this story relating to that, but those are interesting numbers to note. Does not reflect the numbers we're seeing, or it doesn't hold hands with the number we've been talking about relating to the National Association of Home Builders confidence numbers. But it is up from last year. So I think in general, that's good news. And that's a national trend. Now, in addition to that, now let's kind of get an idea of what folks are theorizing here. There's a lot of talk about how millennials are about to make the jump. They're about to start jumping in and start buying. And I'm not 100% sure that that's the thing. We've talked about bunches of different surveys, particularly over the last 6 months, that have been trying to guess what's going to happen with millennials. I honestly don't think it's, as I mentioned before, a good thing. I think the timing would actually be bad if millennials decide we're going to jump out and get into this. And I honestly think that in order for that to happen, I think millennials are sort of tuned into prices more than previous groups. I think they saw what happened. I think they understand on some level that real estate doesn't always just go up. It also will go down. And I think these prices are really off-putting for a lot of them. And the real answer to that problem is starter homes. So what needs to happen in order for millennials to get what they need? And it doesn't even need to be, we could say millennials, but I would buy one, and I sure as heck aren't a millennial. Being born before man walked on the moon qualifies me as not a millennial. But I would be totally willing to consider a home like that. But the building world, the manufacturing world, needs to focus on starter homes. And I'm wondering if that isn't the problem. Because maybe the confidence levels we're seeing are absolutely honest. Maybe builders aren't fibbing and trying to just convince everyone that the market's great by saying they're confident. Maybe the concern here is that while builders see opportunities here, they see the biggest chunk of potential buyers showing the greatest number of interest in homes that they really haven't been building, which is the starter home, right? And as we've talked about before, there has to be a decision made to not get the same level of margins that they've been getting with non-starter homes. So how does that work? I was looking at an article from the Wall Street Journal. The next hot housing market is starter homes, according to them. Millennials are buying homes, steering builders toward lower price points. Again, I think that if someone who's a builder goes out and does the research, they may see that this is a very desirable thing for the millennial world. But I honestly think that the reality is that it's true of an awful lot more, a much larger section of the community that's looking to go out there and buy. I know that would absolutely be true here in my area. And it just comes down to builders being able to make it financially feasible. I'm not real sure where the data is coming from here, because I'm not seeing a lot of this article in the Wall Street Journal reflected in my day-to-day. They start off mentioning that the first-time buyers are rushing to buy homes after a decade in the sidelines, promising to kick a housing market already flush with luxury sales into higher gear. A series of data points, according to them, form a mosaic of a generation of young people ready to buy. The number of new owner households was double the number of new renter households in the first quarter of this year. The share of first-time buyers is creeping back toward the historical average, and mortgages for first-timers are on the rise. Okay. According to Doug Bauer, who's the chief executive of the homebuilder Tri Point Group Incorporated, they're crawling out of their parents' basements. They're forming households and they're looking to buy. Now, new households are overwhelmingly choosing to buy rather than rent. Some 854,000 new owner households were formed during the first 3 months of the year, more than double the 365,000 new renter households formed during the period, according to the Census Bureau. Now, what's interesting about this data for us, right? If we're folks that are trying to anticipate demand, we're trying to figure out the smartest way to invest our real estate dollars. That might indicate that you should do a little bit more math relating to whether or not you're going to do a flip or whether or not you're going to do a rent. At the pace with these numbers, in terms of new owner households being double the number of new renter households. Because remember, that was absolutely the opposite for the last few years, really feeding the rental market. Now, if that starts to go soft, as it sounds like it is from this data, and we move forward with the typical attrition of folks transitioning from being a renter to being a buyer. And keep in mind also, we've actually seen that number be lackluster over the last few years. Folks have not been converting from being renters to being buyers with the same regularity that we've seen in past years. But what they're talking about here seems to be folks who fit into that mold of probably being in both camps, being someone who is living with a relative and moving out to buy. And I know that there's plenty of folks in that mode, right? They're staying with their mom and dad specifically because they're saving to get a down payment so they can make that transition. And then you'll see this eating away at the rental market as well. Now, when that starts to happen, the math will start to reflect a decreased demand in those rental units. And a lot of folks who are currently doing rentals would be in a position where they're likely going to get less rent for their property, depending on the levels of demand in your area. Now, that's not going to be the truth here in my area for a while. There is still plenty of demand for rental space. I have kind of seen rentals peak. I haven't really seen rentals increasing in price over the last 3 to 6 months. And in fact, I just did a survey of rental properties in my local area, and I found properties that had been vacant or at least available for rent for over 35 days that were not priced at the tippy top of the market. So my feeling is that, and this is a totally unusual thing, about once a month, I usually sit down and look at rental numbers. And I haven't really seen a lot of things increasing. Everything's sort of, there are a few here and there rentals that have peaked right around $5,000, $5,200 for 4 and 5 bedroom homes in nicer areas. But the ones I'm seeing that fit that bill have, again, been on the market for an awful long time. The properties that are tending to get rented are lower in the spectrum, down closer to $3,000, under $3,000. What's interesting about this is the number of properties that are showing up as available. Now, the last time we chatted about rental properties and me using my local area as an example, I literally could only find four 3-bedroom homes for rent in my area. Well, I just did a search and I found almost 24 homes that are 3 bedrooms or more for rent in my area. And a third of them had been on the market and available for over 30. I think there was one that was 39 days, one that was 42, one that was 33. So these are all much longer on the market than I'd seen in past months and past quarters. So it indicates a softening. Now, does that say that that's what's happening across the country? Absolutely not. But what's interesting about the area I live is it tends to be a leading indicator. When things get soft here, my community is kind of one of those canary in the coal mine type communities where this is a town that's a bedroom community. It's where folks go when they can't afford to get something closer to work in Silicon Valley. So when we start to see things like renting and other things softening here, well, that tends to mean that they're able to find enough up north that they don't come down here. So it's an interesting dynamic to track. The same kind of dynamic can help inform your decisions you're going to make in your local areas, but look for these things, sort of general softening of the marketplace. And these are very easy things to track. You can simply go into Google and type homes for rent in and insert your city name, find different places, see how many homes there are. Now, granted, at that point, you won't be able to compile any historical data, But on sites like Trulia and Zillow, you can at least get a feeling for what is going on with the market and just regularly check in with those numbers and see what you're seeing, see what sort of trends you're seeing. And a way to assess what's going on in your market right now is, particularly when it comes to rental properties, how long have those properties been on the market, or how long have they been noted as still available? And if you really want to get good data, you can then call on each one of those properties and see if they've already rented, get a feeling from the landlord, what their plan is, what they're doing with the property. Particularly interesting is if you call them and they offer you incentives, that would indicate that they're really having trouble getting that place rented. Okay. So the next thing to answer in relation to this, because we sort of started this part of the conversation off with what home builders are going to do, and being drawn by the demand, right? There comes a time when you really want to move a product, you have to go to the demand level where the demand is, right? So while some of these luxury builds and other types of stuff might make sense, it sounds like builders are starting to get the message they need to get those entry-level homes going. Now, home builders are beginning to shift their focus, according to this article, away from luxury homes and toward homes at lower price points. And we've seen a little bit of that here in my marketplace. Remember, about 4 months ago, we talked about all the brand spanking new homes that were getting built right now and how the equation had flipped. Instead of 8 out of 10 being like over $900,000, we were now finding that 8 out of 10 were below that $800,000 mark, below that $750,000 mark, which was a great trend, right? Because last time we were looking at all this brand new construction that I think the cheapest one we had found at one point when we've been tracking that number was somewhere in the 1 million, 1.1 million range. And that's just crazy. That's not an entry-level market. Let's see here. Home builders are beginning to shift their focus away from luxury homes and toward homes at lower price points to cater to this building millennial clientele. Demographers generally define millennials as people born between roughly 1980 and 2000. In the first quarter of this year, 31% of the speculative homes built by major builders were smaller than 2,250 square feet, indicating they were in the starter home range. And that is actually great news, because so many of these new homes that I've seen built that were on the more expensive range were about 2,500 square foot and bigger, according to housing research firm Zelman and Associates. Now, that's up 27% from a year ago and 24% in the first quarter of 2015. Quote, there's an increasing confidence level in that part of the market. The recovery is finally starting to take hold in a broader way. And that's from Greg Nelson, co-founder of California homebuilder TrueMark. The shift reflects a reversal of a pattern that has driven the 5-year housing market expansion. Let's see. The return of the first-time buyer is allaying fears that millennials might eschew home ownership permanently, but it also provides an infusion of new demand while housing supply is tight and home price growth is significantly outstripping wage gains. Now, what's interesting about that comment is it's totally wrong. It's not... They talk about it as if we were really in need of new demand, and we're not. We haven't been meeting demand even while millennials have not been participating in the purchasing process. So I'm not real sure what that is about. Absolutely true that the price growth has been outstripping wage gains, making it more and more difficult for folks to even afford a home. Home prices in February increased 5.8% over the same month a year earlier, and that's according to the S&P CoreLogic Case-Shiller National Home Price Index. However, the numbers don't lie, and we are starting to see more first-time buyers coming out. In all, they've accounted for 42% of buyers this year, and that's up 38% from 2015 and 31%, the lowest point during the recent housing cycle in 2011. Now, those are numbers from Fannie Mae, and they define first-time buyers as anyone who hasn't owned a home in the past 3 years. So this would also include folks who maybe had a foreclosure, had to sort of retreat a little bit in terms of their ownership and recover a bit, which would qualify them, according to Fannie, as a first-time buyer. Now, the article goes on to say that economists and builders said lending standards have started to ease. Getting a mortgage remains challenging for young buyers with shorter credit histories and, in many cases, student debt. And remember, we've already seen programs that are starting to not worry about student debt. Mortgage rates are also expected to rise further this year, posing an added challenge. Rates for a 30-year fixed-rate mortgage have risen to 4.05% from about 3.5%. Let's see here. Now, one other more tangible bit of this that I think is kind of comforting. I'm always about the tangible stuff, right? Everyone will say whatever they're going to say in order to feed whatever machine that they are most vested in, right? So typically from real estate related things like the National Association of Realtors or the California Association of Realtors, that typically the talk is going to focus on things that will encourage more real estate transactions, right? Because that's, with a few exceptions, every now and again we'll hear something come out that for whatever reason seems to be just absolutely factually based. But it really is about what you see on the ground. Now, one interesting thing that we are seeing is that TrueMark is absolutely taking actions to build these entry-level homes. Now, it'll be interesting to see how much of an effect these efforts have. The company is about to begin construction on a 114-home project in the Inland Empire east of Los Angeles. There's doing another one in Manteca, California, about 80 miles east of San Francisco. Both areas were hard hit during the housing crash and were among the slowest to recover. And they're being drawn to these areas for a very logical reason. It's less expensive to acquire the land there to get the work done. These areas that are further away are called exurbs. And they were avoided after the bubble burst in 2006. But because land there is cheaper, they can build lower-end homes more profitably. Alan Ratner, who's a senior home building analyst at Zelman, is quoted as saying, most builders really preferred to stick straight down the fairway right at the corner of Main and Main. They were afraid to go back into the rough where they built a lot of homes in the prior cycle. Now, outside Las Vegas, TriPoint Homes has introduced a new home design that is specifically targeted to millennial buyers, featuring indoor-outdoor patios, deck spaces, yada, yada. Geared towards first-time home buyers, have been selling more rapidly than pricier homes. Now, that's a piece of information I thought was interesting to share. Why? Because that's data that feeds other home builders getting into this. I think that there is, among buyers, now granted, I don't get to have conversations with these big institutional buyers all the time, but I do occasionally get into conversations with folks who do development on a smaller scale. And for them, they want the shortest amount of time between commitment to complete the project and all units sold. They want this stuff to happen fast because one lesson they learned is that things can turn quickly, particularly here in Morgan Hill. We had one development where they started building, didn't finish building until just after the downturn, and it took years to get those units sold. No builder wants to get caught in that scenario. And if you can say to a builder, listen, you may not make as much on each unit, but you're going to sell all these units in a heartbeat. It's going to be a flash, and they're just going to be gone. And the general numbers I'm seeing in my marketplace do indicate that the market is a little bit slower than it has been over the past year and a half. So you put all that together, and that can absolutely fuel a scenario where, while builders may say, well, I'd love to make more money on this, but I'm okay with making a little bit less money faster. And I think that can be a very attractive equation for these guys. As I mentioned, outside Las Vegas, TriPoint is doing some construction. In addition, there's San Jose, California, earlier this year, there was a technology worker. He said it is more expensive than renting, but that he is getting to the stage in life where it was time to buy. That tends to be a pretty common refrain. I'm right near San Jose, California. I've closed several escrows over the last year in San Jose, so I'm quite a bit plugged into how that market works. Quote, a lot of friends of mine bought a home, so I started thinking maybe it was time to buy a home and stop paying rent, who settled on a 3-bedroom townhouse for $690,000. He plans to rent out a room to help with the expenses. Builders say their return to the starter home market shouldn't invite comparisons to the fevered construction of the mid-2000s. Now, we already talked about that, where confidence levels were at their peak and construction was also at a very crazy peak. Quote, one of the misconceptions is that here we go again. This is another 2005, 2006, where all these builders are going to build hundreds of thousands of homes. We're not going crazy, according to the vice president of investor relations at Scottsdale, Arizona-based Meritage Homes. Building executives said one challenge is that many people are buying first homes later in life, meaning that they have higher incomes and greater expectations molded by years of living in luxury downtown rentals. Even Toll Brothers which tends to build homes for the top end of the market. And I have talked about several of Toll Brothers projects, and some of those were those ones that were right up around 1.4, 1.5, even as much as $2 million. Typically builds homes for the top end of the market, is venturing into lower price points. In Houston, the company is building homes starting in the mid 300,000s range, with a typical Toll home in the area costing around $850,000. So there you go. I mean, we've got some general numbers that talk about a slowdown on a month-to-month basis, but also indicate some growth year to year in terms of actual actions being taken by builders. We've got some actual projects we can point to in different areas in some of those more challenging regions, right? 80 miles east of San Francisco, definitely an area that needs building. The Inland Empire in Los Angeles definitely feeds the needs of folks who need jobs or who have jobs in that area. So it'll be interesting to see how this goes. But what we really need to decide as real estate investors is, where do these trends point us to in terms of the best path forward to get our best return on investment? As with other market elements or market changes, I think one smart thing to do is to reevaluate where you are. If you're someone who is starting to see the softening in the rental market and you've been holding a rental now for several years, we're at kind of a peak on property values. Maybe it makes more sense to liquidate that property and move on to something else. If you are just getting into it and you're trying to decide if you're going to do the rent and hold or you're going to do the flip, given demand levels, given what is currently happening in terms of what looks like some level of shift in the interest of the public in terms of moving from being a renter to being a buyer, maybe it makes more sense for you to do that as a flip. And if you are in some of these areas, but you're someone who feels way more comfortable being a buy and hold person, I think having a strategy that assumes less growth in your rent, or having to hold your rent at a certain level, or maybe even a little bit less than current levels, would be smart. Give yourself a little bit more of a buffer in terms of what you can do for positive cash flow. Or simply make the decision, you know what, I'm going to be very nimble here. I'm going to go ahead and charge the maximum rent I can now and just go for it. And as soon as I start to see a switch in the marketplace, then I'm going to go ahead and liquidate the house and move on into a different investment. Now, let's go ahead. I've got one more hit today. I'm going to go ahead and take a quick break. I realize it's bizarre to take a break. That was normally the end of the show. I've got one more thing I wanted to share with you, so don't go away. I'll be right back. Are you ready to jump in and start your search for your first investment property? Maybe you've decided that it's time to own your own home, or maybe you're ready to sell your home and move on to something new. No matter what your goal is, the Rebel Broker can help. That's right. Aside from hosting this show, I am also the owner broker of Whitelaw & Sons Real Estate Services right here in Silicon Valley. With over 25 years experience serving Silicon Valley, Morgan Hill, San Martin, and Gilroy, I or one of my great agents can help you achieve your goals in real estate. So if you're ready to look into taking that next step towards achieving your real estate goals, point your browser at www.soldbyrobert.com. That's www.soldbyrobert.com and get in touch. Let me show you how I will earn your business and your respect. Again, that's www.soldbyrobert.com, or you can call me at 408-852-0525. California Bureau of Real Estate ID 00984-909. Welcome back, everyone. Sorry for doing a break so late in the show. I kind of got on a roll there and lost track of time. One other thing that I thought would be interesting to discuss is, what are current college grads doing? And it doesn't feed this idea of folks jumping in. So 26% of millennial college students, now remember, we're still, millennials are still in this mix. Remember, it goes all the way up to 2000. Technically, all three of my children will be considered millennials, right? One of them's 1999 and the other two are 2000. And so folks that were born just a little bit before that are finishing college now, folks that were born, say, 4-5 years earlier than that, so in 1995, 1994, still millennials. But this is data that came out literally yesterday, saying 26% of millennial college students say they plan to move back home as soon as they earn their degree in order to pay off some of their student loans, according to TD Ameritrade's Young Money Survey about 2,000 young adults. 32% of millennials between ages 20 and 26 say they owe between $10,000 and $50,000 in student loans. The average student loan balance was $10,205. The bottom line is this is prompting a lot more graduates to move back home with their parents to keep costs down. Now, this shouldn't be a surprise. This has been a common refrain that we've been hearing now for over a year and a half. And when you look at how much debt burden these folks have, stuff like this makes a ton of sense. If you look at the amount that costs have gone up or how much debt gets racked up, particularly from college loans, I mean, this isn't something that generations have lived with. This is something this generation has had to live with. I mean, I know I didn't. Somehow I managed to go to college and hold down a job or two during my college experience and pay my way through all the time, walking out with no debt. That's really difficult for folks now because in terms of comparison to everything else, the amount of growth in what it costs to get a college education is way beyond everything else. I mean, it outpaced increases in healthcare, outpaced increases in everything. In fact, if you ever want to just get into a frustrating topic, try to figure out why education has gotten so expensive. It is a unexplainable thing because the cost of delivering education has not gone up at all. So how do we explain that? The cost to deliver healthcare, yeah, you know what? When you're inventing new things and coming up with new processes and all these other kinds of wonderful things, you can see why that might feed a certain amount of escalation in cost in some areas. I've sat in on college courses over the last year. I'm not seeing them doing it in a different way. They're not beaming the knowledge straight into my brain. So there is no new technology. I'm still seeing chalkboards. I'm still seeing overhead projectors. So I'm not real sure where all of those extra costs are coming in. There's a plenty of room to have a debate about that. And if that's ever something you guys want to talk about, fine. But that's not our thing, right? All I can tell you is that is what is happening. Let's see. So more graduates are moving home. Nearly half the post-college millennials surveyed said they had moved back to their parents' home after college. About 1/4 of those who are still in college say they expect to move back with their parents following graduation. Today's college grads are clearly under financial strain due to escalating tuition and stagnant wages, according to the chief strategist at TD Ameritrade. He went on to say moving back in with mom and dad is a short-term sacrifice that could pay off in the long run, but that's only if the boomerang young adults are saving and wisely investing the thousands of dollars they would have spent on rent and other living expenses and paying down their student debt. Let's see. Survey respondents aged 20 to 26 says they think it would be embarrassing to still be living with their parents by age 28. However, nearly 30% of respondents say they wouldn't start to feel embarrassed until they were between the ages of 30 and 34. 11% say they would not feel embarrassed about living with their parents beyond the age of 35. College grads indicate that student loan debt is causing them to delay many aspects of their life. 40% of the survey respondents say their student debt has caused them to delay buying a home on their own. 27% say it has delayed moving out of their parents' homes. 21% blame student debt for delaying marriage. And 25% say it is delaying them from having children. Okay, so there you go. That's the flip side. Here's some actual data from folks coming out of college, from actual millennials, and folks beyond what we would consider fresh out of college age. You're not fresh out of college when you're 26 or 30 or 28. So there's reason to question this market hype about us seeing a ton of millennials jumping out. Now, granted, what feeds that is that millennials make up a bigger chunk of those folks out there getting loans. But let's also keep in our minds that by expressing it in that kind of a number, you could also say, well, then what about the overall number of buyers? Remember, we're having smaller numbers of transactions close at higher prices. So that's fewer actual buyers getting to the point where they've purchased something. So it just means that as a percentage of an already smaller group, millennials are a bigger part of it. So still not representative of what the millennial group should be, but not a huge increase, right? Does that make sense? I feel like I'm painting a fuzzy picture here. But in any event, I don't think we need to necessarily bank on this crazy jump in the number of folks jumping out there to buy, which would continue to feed prices going up. What we really need to do, I think what kicks this off, and kind of full circle here on the show, is if we start to see entry-level homes being put on the market, I don't think these manufacturers are going to be bummed. And here's the other thing we've pointed out on this show. All it's going to take is a flurry of successes, and these folks will rise to meet the demand, and at any level, right? And as they start to realize they can sell these homes faster than the more luxury-oriented homes, the idea of being able to get in and out and recover their money quicker is going to be super attractive. Because I think a lot of these folks are gun-shy about the market. They're not sure what's going to happen. They may tell us how optimistic they are, but when it comes right down to it and having millions of dollars rolled up into a project, the idea of it being wrapped up in that project for a shorter period of time has got to feel a lot better to the folks who are doing the building. Okay. Thank you very much for taking time out of your busy day to spend with me. I do truly appreciate it. Of course, my goal every single show is to give you far more invaluable things to think about and consider than the time you spend listening. Thanks again for listening, everybody. I'll talk to y'all next time.